Hello, folks. Welcome to Market Trends. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone today. It is Thursday, December 11th, 2025. And the title of today's webinar is The Fed Triggers the Potential Small Cap Breakout. Great to be with everyone. Now, we were talking about this last week, talking about what's happening in the banks, things like that. And it's been interesting to see the kind of continuation of some of these forces that we're building. Financials breaking out, banks breaking out, tech stocks not breaking out. So the kind of pattern that has been developing. Let me jump over here to our key ETFs and just show you the standardized returns of some of these, which we will probably be showing. Now, if you want to go to tradestation.com, scroll down the page, you'll see this article. Oh, it's not showing here for some reason. For some reason that should have been there. Regardless, if you go to insights, you go to market insights, it should be on that page. Sometimes it doesn't always jump through, just some weird caching issue on this computer. I apologize for that. Should be able to have it pop up. All right, so the basic thing is, here we go. Fed triggers potential small cap breakout. A lot of things we're going to be discussing are included here. So, we talked last week about the small caps. Let's just take a quick look at this to Russell to begin. This is its high from 2021, and then you can see we basically, we had a high back here in 2024, right after the election, got sucked back down. It was all right around this kind of 2,400, between below 2,500 basically. And then last week, we talked about this on our State of the Market webinar. We noticed that last week was a record weekly closing high. And today we get the follow through. Yesterday we get the follow through. This pattern on the indexes has often given signals. When you close at a record weekly close, the continuation, the follow through often happens. So one point out that pattern worked, and so it's interesting. And I will say, Russell breaking out yesterday was the only index to close at a high, but then the Dow followed through today. And what's very interesting is that I think big picture here, the Russell doesn't matter as much as the dollar index. The big story is we might now be entering the next true leg down for the dollar. And so we're going to get to that, but just remember that this is something which might be really the most important thing overall right now. So if we look at our article, we go through some things at the S&P 500 here, and I want to just quickly kind of mention those. What's interesting, if you look here, I'm going to jump over to this chart, which is the same chart that's in the blog. And what's interesting here is that you can see that we had these two tight little bearish days, and then we had a big bullish outside day. And so this was an inside day. This little negative day here, it was completely inside of the preceding day. I'm not gonna. You can get a show me on TradeStation if you want, and actually show that. If you go to studies, I'll just actually show you quickly. Study at study, and then we go to show me, and then you go to inside, like inside bar, and also you can add outside bar, and you can see this. I'm going to just add those very quickly, and you can see that's an inside and that's an outside. See those little dots? So basically, tight movement inside, boom, bullish outside day, and now today it was an inside day. We must have actually gone above. Today's high was six. Yesterday was 6,900. Today should also be an inside day. I'm not sure why it's not showing that, but today is also an inside day, at least so far. We've not yet taken out yesterday's high. So anyway, tight price action. I think it's an important thing to realize. Now, many times on this, on this webinar historically, we've talked about when you get tight price action. And I think it's important to realize if you look back to um, late 23, look at this. We talked about this a lot at the time, where basically when you get these rallies and the tight sideways movement, this reflects a lack of selling pressure. There's no pullback. There's just tight sideways consolidation. And I think that's an important thing to realize that we seem to be kind of seeing here. We have just a kind of tight sideways consolidation, and that is, kind of consistent with, um, a lack of selling pressure. Trying to show myself on the screen. Now I can't actually do it. Let me see if I can. That's not working right. Let me go back to this. Anyway, I guess you just won't. Here we go. Sorry about that. So it's a lack of selling pressure when you see that kind of tight movement. And that I think is an important thing to realize right here. Now, if we look at this index at the chart overall, there's a few important things that stand out. This is the 9-day rate of change. Now we've noticed that when we're in the smooth uptrend, what happens is this number never really goes much below 1 or 0. It doesn't really, it just kind of stays right. It might spike up to 5 or 6 and then it just kind of comes down to 1. And what that means is it means if you anywhere where people entered, they're higher, 9 sessions later for the most part. And this has been a pattern that has remained in effect during this, kind of bull market. It's interesting to see what happens here when you see, for example, the 9-day rate of change went negative back here on the 7th. And look what it did. It dragged us all the way down for the following time. Even in this period here, once that 9-day rate of change went negative, it took over a week to recover from it. And so I just want to point out this is kind of a useful indicator. If you look, excuse me, look what happened back in March when the sell-off really began. The 9-day rate of change in late February went negative, and it just stayed negative. And that really was a sign. So it's a sign of overall, kind of tightness, lack of selling pressure, and that is what we're seeing here. So I think it's important to kind of recognize that. And I think right now, let's look at the S&P 500. That the 6,900 level is, I think, potentially kind of in sight. Now we had talked about this big bearish outside day back on October 29th, and you can see that we basically got stuck below that level, in late October, mid-November. But now look at how this time we've come back and we've just stayed in that range, just tight consolidation as the 8-day exponential catches up. This is overall, I think, something that's also kind of showing us that we have that potential for, this time clear that resistance. I mean, that's setting up more in that position. I don't have it on this chart, but last week we talked about how the 50-day moving average was starting to rise again after a period of sideways movement. So we could be setting up for an entirely new phase of the uptrend, like we had in October of 2023. The tightness represents that. And we're also in an environment right now where we've had a period of consolidation and sideways movement where things have been able to reset to a certain extent. I think it's important to realize here. So at one point today, it's kind of interesting. The S&P 5, the Dow was up 1%, and the Nasdaq was down 1%, and that's only happened 3 times this decade, and I think only like 6 times since 2006. So that is also highlighting the strong rotation. We're going to be showing you guys some of that. Now, remember also in this workspace, in this article, if you go and you see this, there's a download here. It has a workspace. These things we're showing you are available. Basically on the other MT main, we're going to go back to that workspace. So let's take a look at MT breadth, which is in the zip file that we just showed you guys at the top there. Look at MT breadth. Look at this. New highs. Basically today, the S&P 500 has 54 new highs, which is the most. See, this one here was 49 new highs. So let's look all the way back. You have to go back here. Basically, we have the most highs today since, I'm sorry. It was since here in March. So that day in March 3rd had 57 new highs on the S&P. Today we have 54. So we're seeing more stocks hit 52-week highs. It's also interesting to see, look at the advanced decline line, new all-time high on the advanced decline line. So I think that's an important thing also to realize. We're seeing the rotation, and of course, it's moving away from tech toward other things as we're going to be kind of talking about. Let's look back over here again at this. Let's look at the industrials, XLI. XLI. We talked about this in our state of the market. We said this tight range. We said we said that this was in a tight range with the potential to resolve to the upside, and that's exactly what's happening. The longer the base, the higher the space, which means long period of consolidation. This could be something people look for an extension into next year. And we're going to get to it, but the economic data may really favor industrials here. We talked about last week, Bank of America put out a big note that was bullish on transport stocks, saying that trucking stocks were going to recover. There's been some tremendous price action in some of these names related to transportation. All of them are industrials, and it's very much consistent with this sort of thing we're seeing here on this chart of the XLI. The XLF financial ETF, same thing. New high. So both of these indexes now are doing what the Russell did last week. They're on pace to end the week at a new all-time high. Now, we don't know what happened tomorrow, but I'm just saying that is where these are now kind of pointing. So I think it's important to realize that now is that we are now in a different environment. Now look at XLK, which is tech. Tech ain't there. Not doing it. Look at the Qs. Look at the Nasdaq. It's not there either. And so right now, the Russell breaking out, the Dow is breaking out, the financials are breaking out, the industrials are breaking out. And let's look one more time here at SMH, semiconductors. Let's do just a daily chart of this. You know, is that a double top? I don't know. I'm not going to try and call the top of AI or anything. I would never make a call anyway. The point is could be a double top for now. Just something to think about. We had Nvidia earnings, total shrug. Oracle earnings, people obviously reacted negatively. Broadcom earnings tonight are the last one. So I'm just saying overall, there has been a tendency for people to be selling a lot of this news. So Broadcom overall has had some interesting trajectory. Did a special article recently looking at how it has been growing based on its kind of custom, the custom chips it's doing. It's actually the top performing $1 trillion company this year. It's kind of interesting. It's up twice as much as Nvidia, more or less. So we actually have an article on the blog if you want to check that out. So I want to just kind of mention that. We're going to be getting to this other blog very quickly as well. I want to tell you about. But anyway, the key thing is that if you look here at the semiconductors, the stocks, depending on how exactly you look at it, but I mean, this is something now where people might kind of, see some potential risk of some stalling here. The SMH, the semiconductors XL, the semiconductor index it has a stronger chart than the overall NASDAQ, right? The overall NASDAQ is below its high. So when you look at the overall NASDAQ, the larger companies, we're seeing something here in terms of that shift away from the large caps. And I think that's important just to kind of realize. Okay. So also, I think very important right now to take a look and kind of realize is that I mentioned the dollar index, but take a look at oil. Oil today, under pressure. Now, we've talked about this, the fact that there's just more oil in the world right now, and there's all this oil sitting around on tankers because of the whole Russia thing. And at a certain point in time, people have said, people watch oil market, what has happened repeatedly is that they put sanctions on Russia, and then after a few months, they figure out a way to get around the sanctions. And so, just saying, there's vast amounts of oil sitting on tankers in the ocean, and if once the people kind of whatever happens at a certain point in time, if that oil re-enters the market, that is something just to think about. So I think it's hard right now to actually overstate the potential positives that remain in effect in this market. We're looking at an environment with oil being heavy, the dollar being weak, the Fed not being hawkish, yields moving lower, earnings accelerating, all at the same time. And there was more data today I'm going to get to, but I think this is important to realize right here. This chart of oil is not consistent with yields moving higher. This is something here where we have to realize is that there was, and we said on our webinar on Monday, we said there was a risk, not a majority risk, not a large risk, but the thing that everyone was worried about was we were going to have a replay of September 2024. That was when the Fed cut and the market spiked and the yields spiked. This time the Fed cuts and it stays calm. And this is to me the most important thing. The 10-year Treasury yield is stuck under 4.25. That is in many ways the most important thing I think of this entire week. Jerome Powell basically had a Hall of Fame meeting yesterday. They threaded the needle in a way that I think people don't even understand how amazing that meeting was. They basically managed to cut rates, to then say they're not going to cut rates again, and still push down yields. At the same time, they basically, by announcing this QE light or this kind of Treasury bill purchases, which begins tomorrow, I believe, on the 12th. So they're doing something now when it's like the ultimate compromise that has basically balanced all these risks. We basically have now they've managed to not cut one rate cut next year, maybe. But the key thing is that I never believed that anyone wanted a lot of rate cuts. The bond market is scared of the long end of the curve shooting higher. That is what we saw in September of 24. And by basically avoiding that, it's counterintuitive, but the basic point is the market doesn't want to have that that inflation thing run out of control and have the long end of the curve shoot higher. So they balance that risk while at the same time not causing a big freak out in the market. I think that people are going to look back on this as being one of the great engineering achievements by a Federal Reserve chairman. And I think people really underappreciate what a momentous meeting that was in the fact that it just nothing happened. And I think that's just huge. So anyone just carry on. But to me, it was really amazing to kind of see that. But now, like I said, look at the yield, look at the VIX, just completely getting smeared lower. And this is what happens. And we've talked about our cycle. In fact, let me try and find my volatility cycle. But we've talked about this at times. You get this sort of the market goes through these cycles, and we are now in an area here where basically this is where we are. VIX is falling, and when that happens, people step into kind of unique trades. Some of these individual areas like banks or whatever, sometimes it could favor tech. Doesn't really say it favors one market, but what matters is now's the time we start to see individual things really move. And the broader S&P, what's it doing today? It's up like 0.12%. But individual things like banks are flying, gold miners, metals are flying. This is a stock pickers market. Where'd it go? Right here. VIX falls, correlation diminishes, and people can trade individual stocks and look for those individual opportunities, which we're going to be getting to in a couple of minutes. Let me just tell you, there are some potential things people might see here as potential opportunities, and we're going to be getting to those. So it's really important, I think, to see that. Now, let's take a look over here at our key ETFs on our MT main. So MT main is the main workspace we use. You guys, let me hide myself so you can see it. But basically, the first thing I want to point out is the growth versus value. Look in the last 3 months, the 63D, that is basically 3 months, it's 63 trading sessions. IWD, which is the Russell value, is outperforming Russell growth in the trailing 3 months. It's really beating it in the last week, the last 2 weeks. But we are now in a spot where the trailing momentum supports value over growth. Just realize that. This is kind of like the sort of momentum tailwind that can get behind people in the market here. So I think that's really important to realize. Look at the trailing kind of 3 months. Metals and small caps outperforming. Semiconductors outperforming, but that's like the only thing in growth that really is outperforming. I mean, tech is still outperforming, but the key thing is you can really see that the overall growth mix is moving toward, the overall mix is moving to value away from growth. So what does that mean? It means things like financials, metals, industrials, small caps, banks. That is where the focus is. Meanwhile, the major value sector, industrials, are weak because energy is weak because why? Because oil, like we said, going lower. You can't have it's hard to actually, I think, realize what a favorable potential mix this is for risk appetite, with oil going down, yields going down, the dollar going down, and earnings going up. So, and there was some other stuff happening here. So, the other thing, let's take a look here at the bank index, the BKX, the NASDAQ. This is the KBW bank index breaking out to a new all-time high. So banks here, I think we talked about this last week. We basically talked about the fact that you have Michelle Bowman a week ago on Monday. She came out and made statements in front of Congress that were extremely favorable for the banks. It was basically about how there's not going to be a lot of restrictions with capital requirements, and there'd be like a kindness or a tolerance toward M&A. And then we have to realize, you go to another country like, I don't know, England. I mean, England's not as big as us, but they only have a few banks. You go to a country like England or a lot of these other countries, they have like 5 banks. America has like hundreds of banks. There has been, I think, a potential bullish condition in the regional banks for a long time for M&A. And I think right now, when you look at them, there's that potential. There's been a few deals this year, but regional banks, a lot of these companies trade for like 10, 12, 13 times earnings, and there's potential for people to consolidate them. And if there's anything, when you think of AI, I mean, that is right here an opportunity for people to use AI to basically combine banks, reduce headcount, probably reduce, footprints. So you're talking potential for massive accretion via M&A. So I think people realize here is that the banks are in a very interesting spot, and they are still in a much less risky, they are much less leveraged now than they were during the financial crisis. And the other thing is that right now, if you go back to like 2005 versus now, I mean, at that point in time, they were running higher debt levels, and the American consumers were at higher debt levels. Now you have the opposite. The banks are less risky, and the consumers are less leveraged. It just creates an opportunity for some significant sort of runway ahead of these financials here. So I think right now, I mean, I know everyone likes talking about AI and tech stocks and Tesla and things like that, but we got to look at price. Price is truth. And this is telling us something here. And I think this is really a key thing like this, the dollar index, these are really telling us something important. So I think take a look at this article we've done some time back called Why Stocks Move. You can Google TradeStation, Why Stocks Move. Google that and you'll find this article. It was from back in September, but we've republished it a few times. The key thing is that AI is a fundamental story. It is a fundamental unit growth story, and we've talked about that, which is volumes. You're selling more chips, you're doing more compute, you're doing more models, blah, blah, blah. You're doing more stuff. It is secular growth, and that's a form of growth, and it can work and drive the market. But there are other catalysts that can drive the stock market, and one of those is investor rotation. So I think you got to realize here that there is some potential here at the end of a year, with certain things feeling heavy and other things igniting. We have the potential here for a rotation from growth to value. And that kind of thing can last for quarters at a time. So the thing is, if this remains the case, I mean, we could be in a spot where like the large growth stocks, the NASDAQ and everything don't do much of anything. And then these other areas like financials and industrials could lead. So this has happened before. Investor rotation is an important theme, and especially with the new year coming, it has that potential for a refresh and for things to kind of reset. Now the other thing is macro trends, and the main macro trend is the dollar going down. That is something that creates the potential for strengthened materials and a different kind of risk appetite. So I just think it's important to realize that we're in an environment now where the focus can shift from secular growth based on volume to things like macro trends, investor rotation, and also margins. Like I said, you're a regional bank and you consolidate and you cut costs and blah, blah, blah. That is a margin story. So these are other kinds of catalysts that can come into play and drive the market here potentially, and it seems to be kind of happening. I want you to take a look at some of these individual names here. Like, for example, I'm just looking at this chart. Look at Dollar Tree. We wrote about this in our weekly recap, but we were talking about some of these retail stocks. Look at a stock like this. Now look at a stock like Nvidia. I mean, this thing is going nowhere. Look at like Tesla. These things are like, it's under the, isn't hitting new highs. It's like kind of stuck. Look at something like Dollar Tree. Look at things like Dollar General. Look at things like, I think Tapestry had a good breakout today. Some of these things we talked about, things like Ralph Lauren and things like that. But the retailers here, I know it's not something people are focused on, but the retailers here are showing some significant strength. Remember, as you look out to next year, what do we get? We basically are going to get some kind of, I mean, I honestly have to admit, I don't know if it's stimulus checks or if it's going to be tax credits, but whatever. The big, beautiful bill is going to actually result in an estimate of at least $1,000 per household that's going to be, entering the economy on the consumer side in the first part of next year. So retail, all these things, just bear in mind. The other thing is this industry has been through the absolute ringer for the last decade. We had the retail apocalypse when thousands of stores closed in the US. And the thing is these companies, if they've survived, and now you're in an environment when they've downsized and they've done all the stuff they have to do operationally, and now all of a sudden you get stronger growth. Say, for example, you get a better employment market next year, things like that. And I think that's the key thing to bear in mind here is that these forces are coming together now. And some of these things like retailers, they're so much smaller than the big tech names. So the thing is, tiny little drops of money can leave NVIDIA and go to these smaller retail names and generate outperformance. And it seems to be what's happening. That's the key thing about investor rotation. Sometimes when you leave the big stuff, the amount that the leverage that can go into the small things as a percentage is significant. Okay. Also, Eli Lilly. I think we have to realize Eli Lilly hit $1 trillion. It pulled back to $1,000. It had some positive data today. look at this chart. I mean, I think right now, look at how it's holding this high. I mean, it's just near this high from last August, or no, actually August of 24. I mean, this is, I think, a name people, look at. These are on people's radar. Some of these are names like Merck or things like that. Another one that I had noticed was Medtronic, MEDT. Had this rally on earnings. It's kind of holding above there. We had talked about some of these other names like Intuitive Surgical. This is maybe something that's not as much of an overall theme of just healthcare per se, but it is interesting to me to look at what's happening in Eli Lilly, because this is a name that has gotten some attention. And I don't know. To me, this is actually something that might actually be on some people's radar. Okay, so we also have things happening in some of the metals names. We had talked about stocks like Freeport McMoran, and this stock I think is very, people might want to just realize that here's a stock that basically is, below levels from a long time ago, with, metals, weak dollar, all those things kind of coming together. So I think Freeport is another name people might want to kind of pay attention to here. We're going to actually get to that in a second. Now, what's also interesting today when we look out is that there's a bunch of interesting data today. So, for example, CNBC had an article that quoted some company called Parcel Labs. I don't know them, but they basically were talking about how home prices went negative and are going to remain negative. Now, there's been all kinds of data, all kinds of people put out there. You have Case Shiller, you have like Zillow does stuff, and Realtor.com. They all publish articles at different times, but they're all pointing in the same direction of basically home prices are likely to fall. So, and I've been saying this for a while, this market has been frozen. And when people start transacting homes, they, what's going to happen is people who, they're still looking at their house back in the price from 2021, and it's like, oh, my house is worth $1 million. It's like, no, it's really worth about 750,000, but you haven't adjusted your price yet. And oh, I have to move. Oh, now I got to start cutting price. So what happens is, as the market activates, in this case, it's going to lower prices. And so we're setting up now for an environment where lower interest rates can result in lower inflation. And now I know that goes against a lot of economic thinking, but when you look at the actual dynamics of how the market works, we have to realize is that interest expense is an input into housing. And if you make it cheaper, it can make housing cheaper. So the actual thing here is that as the market activates and there's more listings and home prices come down, we can look out into next year and potentially see a negative pull on CPI from shelter, which is 36, 38% of the index. So that is out in the future as well. Another thing that was interesting today was today had the biggest increase in jobless claims in like 4 years. That's something that's kind of dovish. We had a much smaller trade deficit, which is good for GDP. The other thing to remember is next year is an election year, and that means that there could be things that are more favorable for Main Street. Now, I also think another point, I have not heard anyone make this yet, but I would not be surprised if this becomes a talking point in 2026, which is that there is a growing public backlash against AI and data centers. It's pushing up electric costs. It's doing this. It's doing that. These companies have made a lot of money. They're worth a huge amount. And going into an election year, next year, you have to ask, will they become a target of political attacks in different ways? Will there be regulations? Will there be talk of this or talk of that? And I could see there being a bipartisan pushback against AI next year when both candidates on either side are going to be running potentially saying, we need to do this, we need to whatever, we need to raise their tax, whatever. The point is that an environment like that, people might say, these stocks have gone up a ton. They've gone up, thousands, hundreds percent, whatever. Is it something now where the risk is not as favorable? So I think you have to also realize that the AI story now is no longer new. And we said this last time. We said this story is now a 3-year-old story. ChatGPT started November of 2022, I believe it was. So the thing is that we're now at a spot where I think there could be some political pushback on AI stocks, and that's another reason to think about rotation with the new year coming. There also today, very quickly mentioned, is that there was an upgrade in Visa. I can't remember who did it, but it's interesting. Look at Visa and MasterCard. Both of these stocks are breaking some downtrends here. I think that's kind of interesting one to point that out. Today we did a trading view idea on Marriott. This chart had some inching patterns, pullback held this level. That was an all-time high here. I think this is something here where people, looking at some of these things, travel and stuff like that. Airlines have been very strong, and it could point in a direction. It's the Jets, the airline ETF, but it does create a potential here, I think, for Some of these names, consumer discretionary names, Main Street names. We said last week, is Main Street coming back, and that things like Marriott could potentially fit into that. Another name that's potentially interesting is Johnson Controls. They do air conditioning for data centers, and they also do stuff for auto parts. Company's had this bullish gap on earnings, has been holding right there. It's one people might want to take a look at. Um, Newmont Mining, gold miner, actually it's called just Newmont. Yeah, Newmont Gold Corp, whatever it's called. It's changed its name many times, but this stock is just now breaking out, and people might want to look for some option strategies in a name like this. Now, talking about Freeport, I wanted to show you over here very quickly on Option Station Pro. A person might look at Freeport and say, you know what? I mean, does it go to 55? I mean, look at the chart here. It peaked, you know, in mid 24, up around 55. So a person might go over here and look at the expiration and say January, and say, what would happen if we could, looked at like the 50 calls, and we then basically looked at the 55 calls. That could be a potential vertical spread for about $1, which would make about 400% if the stock goes up to 55. So I think we're going to point that out. This is a sort of environment where metals have been strong. I think that's important. Freeport is a huge copper stock. It is one of the few metals companies in the S&P 500, and one of the most in terms of options activity. So I think that's an important thing to realize. We're always looking for the stuff that has the options activity that can give the potential liquidity. All right, now, next one I wanted to show is Ford Motor. Take a look at Ford Motor here. Ford Motor can benefit from low interest rates potentially. Here's a stock that, at one point it was, closer to 20. And here it is, with some levels here, but it's been basing here for a while. And you got to also wonder, GM's been doing well. Ford did rally on earnings last time. It's in this range. People might want to take a look at Ford Motor and say, you know what, something like a move to 15. After this period of consolidation, people might look for a move back to that level from late 23. And take a look over here on Ford Motor, and a person could look, for example, at the 14-15 vertical here. Are we still in January? Let me make sure. Yeah, in January, the 14 to 15 vertical. Look how inexpensive these options are, like 33 cents. But basically, that costs 24 cents. So again, 24 cents for a $1 spread. That might be something people look at. That's a potential 300% from the stock moving up to $15, which is about less than, like, around 10% from where it is right now. All right, so that was Ford Motor. Another one that's on my list, but I just want to mention, is Bank of America here. I mean, the other banks have been breaking out, and this one has not yet. But look at how it's holding here. This might be one people actually look for some potential continuation to the upside in Bank of America. Now, Broadcom does report earnings tonight, and for me, if people want to look to the upside, they might actually look at something like Broadcom, at the weeklies, because the December 12th options expiring today, and a person might look, for example, at something like the 425, 435 call spread. In this case, it could something like the that spread 425 to 435. That's a $10 spread for about 240. So something like that could potentially capture the upside. And if you're worried about people selling the upside, then another thing, or people taking profits and things, then people might be looking to the downside, and people might look for something in terms of a put spread, something around looking for a drop into like the 380. So for example, the 385 puts down to the 375s, that would cost about $2.12, and a drop to 375 would be right about here on the chart, which is more or less where it was the beginning of December, on December 3rd. So I want to point out one other thing here. It's interesting. You love the Option Station Pro. Look at the implied volatility. Look at on the calls. This is called skew. So the stock's at 407. So you look right at the money here. The calls have implied volatility of 152%. And then you can see these are 150. Earlier in the day, it was a wider. And that tells you people are buying more calls than they're buying puts. And it just kind of shows there's an upside skew. So I love how you can see that so easily with Option Station Pro. And then the last thing, yeah, those are the main things I wanted to cover. I'm running over time. Sorry about that. I will see you guys on Monday for State of the Market. And hope everyone has a great day, great weekend. We'll see you Monday. Thank you very much.